November 11, 2022. A 30-year-old billionaire files for bankruptcy. $8 billion of customer money, gone. Not lost in bad trades, not stolen by hackers, taken by the very person customers trusted to protect it. This is the story of Sam Bankman-Fried and FTX, the fastest rise and most spectacular fall in cryptocurrency history. A tale of deception, greed, and one of the largest financial frauds ever prosecuted in the United States. Welcome back to Financial Mysteries. Today, we're unraveling the $8 billion heist that shocked the world. Sam Bankman-Fried, known as SBF, wasn't supposed to be a villain. MIT graduate, son of Stanford law professors, a self-proclaimed effective altruist who claimed he'd give away his billions to save the world. By age 30, he was worth $26 billion on paper. He hobnobbed with celebrities, bought Super Bowl ads, testified before Congress. Major publications called him the J.P. Morgan of crypto, a responsible adult in a Wild West industry. FTX, his cryptocurrency exchange, processed billions in daily trading volume. It was valued at $32 billion. Venture capitalists lined up to invest. Celebrities like Tom Brady and Gisele Bündchen became brand ambassadors and investors. But behind the carefully crafted image of the quirky genius in cargo shorts playing League of Legends during meetings, a different story was unfolding. FTX launched in 2019. Within 3 years, it became the second-largest crypto exchange in the world. The growth was meteoric. Too meteoric. Here's what the public saw: a revolutionary trading platform with low fees, innovative products, and a charismatic founder preaching about using wealth for good. Here's what they didn't see. FTX was intimately connected to another company, Alameda Research, a trading firm also founded by Sam Bankman-Fried. On paper, they were separate entities. In reality, they shared the same office, the same leadership circle, and the same bank accounts. Caroline Ellison, Sam's on-and-off girlfriend, ran Alameda Research. Gary Wang, FTX's co-founder and CTO, built backdoors into the FTX code, special privileges that allowed Alameda to borrow unlimited funds from FTX customer deposits without triggering margin calls or liquidations. Red flags were everywhere. FTX had no board of directors, no proper accounting department. Financial records were kept on QuickBooks, software designed for small businesses, not multi-billion-dollar exchanges. When questions arose about reserves, SBF tweeted reassurances. That was enough for most people. The Bahamas became their headquarters, a tropical paradise with loose financial regulations. SBF and his inner circle lived in a $30 million penthouse. They partied, they played video games, and they gambled with other people's money. Here's how the scheme worked. When you deposited money on FTX, you expected it to sit safely in your account until you decided to trade or withdraw. That's how exchanges are supposed to work. But FTX treated customer deposits as their own piggy bank. Through the backdoor Gary Wang programmed, Alameda Research could borrow billions from FTX customer funds, without collateral, without limits, without anyone noticing. What did Alameda do with this money? Risky cryptocurrency bets, venture capital investments in hundreds of startups, real estate purchases, political donations. SBF became the second-largest donor to Democratic candidates in 2022, giving over $40 million. They even propped up failing crypto companies during market downturns, playing savior with money that wasn't theirs. The irony? SBF was praised as the responsible billionaire saving the industry while secretly looting customer accounts to fund it all. The house of cards was built on FTT, FTX's own cryptocurrency token. Alameda's balance sheet was loaded with FTT tokens. On paper, they were worth billions. In reality, if anyone tried to sell large amounts, the price would collapse. It was phantom wealth, and everyone in the inner circle knew it. By mid-2022, Alameda Research owed FTX approximately $8 billion. Customer money. Gone. November 2, 2022. CoinDesk publishes a leaked balance sheet from Alameda Research. The revelation: Alameda's assets were heavily concentrated in FTT tokens, the same token created by FTX. The connection between the two companies was undeniable. November 6th. Changpeng Zhao, CEO of Binance, FTX's biggest competitor, announces his exchange will liquidate its FTT holdings worth over $500 million. The message was clear. He'd lost confidence in FTX. The FTT token price crashes. Panic spreads. Customers rush to withdraw their funds from FTX. November 8th. FTX blocks withdrawals. The exchange doesn't have the money. SBF tweets that FTX is fine. Assets are fine. It was a lie. Behind the scenes, he's desperately seeking emergency funding, $8 billion to plug the hole. November 9th. Binance announces a potential acquisition of FTX. Hope flickers, then dies within 24 hours. After reviewing FTX's books, Binance walks away. The situation was far worse than anyone imagined. November 11th. FTX files for Chapter 11 bankruptcy. Sam Bankman-Fried resigns as CEO. In a statement, he says, "I'm sorry, I fucked up." The understatement of the century. The new CEO, John J. Ray III, a restructuring expert who'd handled the Enron bankruptcy, later testified that in his 40-year career, he'd never seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. Customer funds weren't segregated. Money was used to buy personal property. Loans were given to executives without documentation. It was, in his words, old-fashioned embezzlement. December 12, 2022. Sam Bankman-Fried is arrested in the Bahamas and extradited to the United States. He's charged with wire fraud, securities fraud, money laundering, and campaign finance violations. Caroline Ellison and Gary Wang immediately plead guilty and agree to cooperate with prosecutors. The walls close in. SBF's defense? He was just bad at management. He didn't know where the money went. It was all a big misunderstanding. Nobody believed it. November 2nd, 2023. After a month-long trial, a jury finds Sam Bankman-Fried guilty on all 7 counts. The evidence was overwhelming. Testimony from his closest associates, internal documents, encrypted messages showing he knew exactly what was happening. March 28, 2024. Sentencing day. The judge hands down 25 years in federal prison and orders $11.02 billion in forfeiture. At 32 years old, Sam Bankman-Fried won't be eligible for release until his mid-50s. The bankruptcy estate has managed to recover approximately $16 billion in assets, enough to potentially repay customers in full, plus interest. A rare outcome in fraud cases of this magnitude. The FTX collapse wasn't a hack. It wasn't a market crash. It was theft. Plain and simple. $8 billion stolen through lies, backdoors, and betrayal. Sam Bankman-Fried built his empire on a foundation of fraud, dressed it up in the language of altruism, and convinced the world he was different. He wasn't. The lesson? Trust, but verify. Reputation means nothing without transparency. And in finance, as in life, if something seems too good to be true, it probably is. This has been Financial Mysteries. If you want to dive deeper into financial scandals that shaped our world, subscribe and hit that notification bell. The next mystery is just around the corner.